Something quietly snapped over the last few days, and most people missed it because they were staring at screens instead of systems. This did not begin with a headline, a speech, or a market alert. It began in the physical world, where ships cannot move faster because algorithms blink green, where factories cannot double output because leverage exists, and where governments eventually remember a brutal truth. Resources are not ideas. They are real, finite, and unevenly distributed. While paper markets argued with themselves overnight, the scramble for physical silver, energy, and strategic minerals moved from background tension to open confrontation. Once that shift happens, it does not reverse calmly. The world people keep predicting has already arrived. A multipolar world is no longer a theory. It is the operating environment. In this environment, the fight is no longer about interest rates, valuation models, or quarterly earnings. It is about who controls oil, gas, rare earths, industrial metals, and silver. These are no longer passive inputs. They are weapons. That is why events that appear political on the surface are almost always resource wars underneath. World War today is not announced, it is enforced through supply chains. This is where confusion begins. People see volatility and assume speculation. They see price drops and assume weakness. In reality, two systems are colliding. One system trades promises, leverage, and paper claims. The other system moves metal, energy, and physical supply. These systems are no longer aligned. Paper pressure appears during thin hours, while physical demand shows up when real buyers step in. That is not manipulation theory, that is structural conflict. This is not one spark, it is a chain reaction. When pressure suddenly builds around an oil-rich country, it is rarely about democracy or stability. It is about barrels, pipelines, and settlement currency. When shipping routes become flashpoints, it is not symbolism. It is minerals below the surface and control above it. When Middle Eastern tensions rise, ideology becomes the headline, but energy flow is the substance. Headlines are decoys. The real story is what the headline allows someone to do next. Every attempt to secure resources through force triggers adaptation, not surrender. Trade reroutes, alternatives emerge, settlement systems diversify. Each workaround weakens the old financial plumbing slightly. You cannot sanction geology. You can sanction banks and companies. But if metal exists and the world needs it, trade will find a path. Every trade executed outside the old system erodes it quietly. That erosion later appears as volatility, pricing stress, and trust decay. For decades, the United States sustained global dominance by running an empire on credit. As long as dollars recycled and borrowing stayed cheap, the bill felt distant. That era is cracking. Rising interest costs, stretched balance sheets, and fragile supply chains make uninterrupted resource access critical. Policy hardens, pressure increases, alliances strain, threats surface, not because leaders are reckless, but because the alternative is industrial decline and strategic weakness. In a multipolar world, refusal is survivable. That single fact rewrites global strategy. Now connect this directly to silver. Silver does not need to vanish to cause chaos. It only needs to tighten. When delivery delays extend and premiums rise, industries start competing with investors. Because silver is affordable compared to gold, public participation accelerates faster. Fear plus accessibility creates demand waves that strain a market already operating on thin margins. Silver sits at the most dangerous intersection. It is an industrial necessity and a monetary metal. Industrial demand keeps rising through electronics, solar energy, medical technology, and advanced manufacturing. Monetary demand rises when trust weakens. Add World War-level geopolitical stress, and you create a volatile compound. That volatility is not noise. It is pressure attempting to express itself. Silver supply does not respond quickly to price. Most silver is produced as a byproduct of other mining operations. Higher prices do not instantly increase output. Mines take years. Refineries take years. Permits take years. Labor takes years. In the short term, supply is fixed. Demand is not. That imbalance defines the battlefield. On the paper side, price can be pushed down quickly through leverage. Claims multiply without metal moving. On the physical side, delivery either happens or it does not. Inventory either exists or it does not. This explains the repeating pattern. Price is hit overnight. Stops trigger. Fear spreads. Regular hours arrive. Physical buyers step in. Price recovers. This is not coincidence. It is a tug-of-war between illusion and reality. Now the weed
Trust weakens. Add geopolitical risk to that mix, and you get a volatile compound. That volatility is not noise. It is pressure trying to express itself. Zoom out further and the pattern becomes clearer. When power decentralizes, competition shifts from financial engineering to resource security. Rare earths, critical minerals, and industrial metals are not optional luxuries. They are prerequisites for defense systems, artificial intelligence, energy storage, and technological leadership. Yet much of the refining and processing capacity for these materials has lived outside the United States for years. That realization did not arrive gently. When policymakers recognize that a large portion of military and technological supply chains depend on rival spheres, urgency replaces comfort. Executive orders appear. Strategies get drafted. Domestic mining suddenly matters again. But reality does not scale on slogans. Mines take years. Refineries take years. Permitting takes years. Skilled labor takes years. Capital takes years. In the short run, you cannot build your way out. You secure what exists. That is the backdrop for the current resource scramble. Currency cannot be separated from this. Reserve systems persist through incentives, enforcement, and convenience until they do not. Years ago, major energy producers began building deeper ties with non-Western buyers through infrastructure, logistics corridors, and long-term investment frameworks. These were not symbolic gestures. They locked in future trade flows, and trade flows determined currency usage. The petrodollar system was never magic. It was a deal. After the final break from gold in the early 70s, oil settlement created global dollar demand. That mechanism stabilized the system for decades. But deals evolve. Some seek flexibility, some want reduced sanctions exposure, some want leverage. The result is the same. The dollar remains dominant, but no longer unquestioned. When effortless resource access through currency weakens, supply chain security takes priority. That urgency explains the frantic tone beneath current events. And that is why silver matters here. It is not a shiny distraction. It is a stress point in a system adjusting to a new reality. The deeper problem sitting under all of this is not whether a currency disappears, but whether it keeps its purchasing power. Currencies rarely die dramatically. They erode quietly. Even if a unit remains dominant in transactions, it can still buy less over time. That is the danger most people underestimate. This is why commodities matter so much, especially metals that carry no counterparty risk. Gold and silver do not rely on trust in an issuer. They rely on physical existence. The United States has spent staggering amounts of capital across decades. Foreign conflicts, security commitments, reconstruction efforts, and long projects with limited returns have left an enormous bill. In some regions, years of involvement ended with withdrawal and little lasting stability. At home, obligations continued to grow. Defense budgets expanded. Interest on national debt surged. The debt stock itself ballooned. That is not ideology. It is arithmetic. Add corporate leverage, household debt, and an immense derivative structure layered on top, and the pressure becomes structural. When that pressure meets a multipolar world, sensitivity increases. Any threat to resource access feels existential. This is where silver re-enters the story with force. Silver is not a novelty investment. It is a functional input used across modern infrastructure. Electronics, energy systems, medical applications, and precision manufacturing depend on it. At the same time, it carries thousands of years of monetary history. That dual role creates a unique vulnerability. Demand does not come from one channel. It comes from industry and from defense against currency risk. There is another uncomfortable detail. A significant portion of silver consumed domestically is imported. Depending on the year and the measurement, reliance remains substantial. That means supply chains and trade relationships matter deeply. In a world where relationships are being renegotiated, that dependency carries risk, and the demand is not isolated. Major buying nations have been importing silver at record levels measured in dollar terms. When a country steadily increases silver imports month after month, it signals intent. Silver is being treated as a strategic asset, not a speculative toy. You can feel this tension in market behavior. On the paper side, leverage allows price to move sharply in the short term. Claims can be created, rolled, and settled without metal changing hands. The physical side operates differently. Delivery either happens or it does not. Inventory either exists or it does not. That distinction explains the repeated pattern that keeps frustrating traders. During thin overnight sessions, price is driven down, stops are triggered, narratives form. Then regular hours arrive, physical demand appears, and price starts clawing back. This is not coincidence. It is structural conflict. This matters because it reveals a tug-of-war between two realities. One reality manufactures abundance through contracts. The other reality must deliver metal. When the physical side remains firm, paper pressure loses psychological power. Buyers who want metal do not panic over a short-term candle. They see weakness as opportunity. Each purchase removes inventory from circulation, tightening the system further. Look at demand beyond a single region. Broad buying has been visible across multiple areas, including nations with large industrial bases and regions with deep experience in precious metals as wealth protection. When wealth funds and institutions quietly add exposure to hard assets, they are not chasing headlines. They are hedging systemic risk. Meanwhile, rare mineral processing remains heavily concentrated outside the Western sphere. That is not political commentary. It is industrial reality. This concentration creates strategic vulnerability. If refined materials essential to defense systems and advanced technology come from rival spheres, leverage exists whether acknowledged or not. Attempts to reshore or friendshore processing are underway, but they cannot be completed quickly. Building capacity while simultaneously securing external access creates competition. That competition is showing up alongside rising metal prices for a reason. Currency mechanisms amplify this effect. Many assume dollar usage is inevitable. In truth, currency dominance is a network effect. Network effects decay slowly until they do not. When energy producers and major buyers sign long-term frameworks involving infrastructure, technology, logistics, and industrial zones, trade becomes sticky. Sticky trade reduces the need to recycle capital through legacy channels. This process does not flip a switch. It bleeds over time. In transitional periods like this, hard assets function less as speculation and more as insurance. As resource competition intensifies, government responses often involve financial tools, export restrictions, import controls, sanctions, regulatory pressure, and capital management measures appear. These actions distort supply, raise costs, and push trade into alternative channels. Each step increases the appeal of portable, permissionless assets that sit outside financial plumbing. Silver carries another overlooked characteristic. Supply does not respond quickly to price. Much silver production occurs as a byproduct of other mining operations. That means higher prices do not instantly generate more supply. Output depends on the economics of base metals. Even sustained price increases can result in slow or uneven responses. This is why tight conditions persist longer than expected. When analyzing charts, context matters. Price action reflects behavior under stress. Right now, behavior suggests an attempt to reprice scarcity, while a leveraged structure works to contain it. That tension defines the market. Zooming out removes emotional whiplash. Gold on a weekly time frame has been grinding higher, digesting gains rather than collapsing. Pullbacks test resolve. Strong markets retest former ceilings and build support. Silver behaves more violently. It whipsaws, shakes confidence, and rewards patience unevenly. On longer time frames, a large base has been forming for years. Breakouts followed by pullbacks are not failures. They are confirmations when levels hold. Recently, silver moved from lower ranges into significantly higher territory in a relatively short period. Moves of that magnitude signal structural change, not random noise. The paper market can suggest abundance, but physical buyers are not persuaded by appearances. Overnight pressure has lost much of its intimidation because it is repeatedly met by real demand. Each cycle drains available metal. Tight markets tighten further. This leads to a larger rotation that remains underappreciated. When broad equity indices are measured in ounces of silver rather than dollars, long-term trends shift. Periods dominated by financial assets eventually give way to phases favoring hard assets. Ratio breakdowns signal that transition. Even modest reallocations from massive pools of paper wealth into comparatively small metal markets can drive disproportionate moves. Silver does not need universal participation. It needs marginal shifts. These dynamics sit within a geopolitical backdrop defined by fragmentation. Large multi-sector agreements, new trade corridors, and alternative settlement systems are not abstract concepts. They change incentives. Governments stockpile. Industries secure long-term contracts. Investors anticipate scarcity. Institutions accustomed to paper assurances confront delivery constraints. This is not simply a trade. It is a symptom of reordering. Understanding that distinction changes behavior. Volatility becomes a feature, not a flaw. It shakes out emotional responses and transfers exposure to prepared participants. Surviving this environment requires anchoring to long-term structures rather than reacting to short-term noise. The final layer of this story is psychological, and it is where most people lose their footing. In periods like this, markets are designed to exhaust attention. Price rises create fear of missing out. Sharp drops create embarrassment and regret. The cycle repeats until participants detach emotionally or exit entirely. That pattern is not accidental. Volatility functions as a filter. It transfers exposure from those reacting emotionally to those operating with a longer horizon. Silver, more than most assets, amplifies this effect because it moves fast enough to provoke emotion and slow enough to punish impatience. This is why anchoring matters. Without a macro anchor, every move feels personal. Every dip feels like failure. Every rally feels temporary. Anchoring to long-term structures changes interpretation. Monthly charts, ratio analysis, and supply constraints tell a different story than intraday candles. They reveal accumulation beneath chaos. They show that price swings are expressions of stress rather than signals of collapse. Paper pressure tends to strike where resistance is lowest. Overnight sessions provide thinner liquidity, making it easier to push price, trigger stops, and shape narratives. That strategy relies on psychology. It assumes holders will react defensively. But when physical demand remains firm, the strategy weakens. What was once an intimidation tactic becomes a discount mechanism. Buyers step in. Inventory moves out of circulation. Each cycle requires more effort for less impact. This is how battles are lost quietly, not through dramatic defeat, but through diminishing returns. The physical market does not argue. It either absorbs supply or it does not. And recent behavior suggests absorption remains strong. Demand is not localized. It spans industrial users, strategic buyers, and individuals seeking insulation from currency erosion. Silver's behavior historically follows a pattern. Long periods of frustration are followed by sharp repricing phases. It coils, compresses volatility, then releases it suddenly. Those releases rarely announce themselves politely. They tend to surprise consensus because consensus is conditioned by recent pain. When repricing occurs, it often feels disorderly. Models fail, forecasts lag, explanations follow price rather than lead it. This is why timing precision is less important than structural positioning. No one can consistently predict the exact moment repricing accelerates. But the longer a base forms, the greater the stored energy. When that energy releases, in a context of geopolitical fragmentation, rising debt burdens, and strained supply chains, the outcome tends to overshoot expectations rather than undershoot them. The broader backdrop reinforces this dynamic. Resource security is no longer a secondary concern. It is becoming central to national strategy. Shipping routes, processing facilities, and mineral deposits are now strategic assets. Competition around them intensifies as trust erodes. Financial tools become weapons. Sanctions, trade restrictions, and regulatory measures are deployed with increasing frequency. Each action creates distortions. Each distortion creates incentives to hold assets outside the system. And this is where gold and silver diverge in role while aligning in direction. Gold remains the anchor metal. It reflects central bank behavior and institutional hedging. Silver reflects public sentiment and industrial necessity. When both rise together, it signals monetary strain. When silver begins to outperform, it often signals acceleration. Silver tends to capture emotion. It moves faster during transitions because it sits closer to everyday economic function. Understanding this helps avoid a common trap. Many expect smooth trends. They expect linear progress. But transitions are rarely smooth. They are volatile, uneven, and emotionally taxing. Markets test conviction repeatedly before rewarding it. Those tests are not moral judgments. They are mechanical outcomes of competing incentives. Consider what happens when even a small fraction of global capital reallocates toward hard assets. The scale mismatch matters. Paper markets are enormous. Physical silver markets are comparatively small. Marginal flows can create outsized effects. This asymmetry is why silver does not require universal adoption to move dramatically. It requires incremental shifts in preference.